Hello, gentlemen. I would like to buy these bananas.
Hello, madam. Those bananas cost €1 per kilogram.
Here you are, gentlemen.
Thank you, madam.
Hello, gentlemen. I would like to buy these bananas.
Hello, madam. Those bananas cost €5 per kilogram.
What the hell happened?
Madam, it is inflation. It increases the price of goods.
Holy jeez. Here, take the money, gentlemen.
Thank you, madam.
Hello, gentlemen. I would like to buy these bananas.
Hello, madam. Those bananas cost €5.
Per kilogram?
Nope. Each one.
I think I'm going to die.
In the last 4 years, the word inflation became very frequent in media.
Despite rising inflation,
You're seeing your costs soar.
Post-pandemic inflation.
Especially when talking about finance and economics. But what is inflation in a nutshell? Today I would like to discuss this concept in the simplest way possible. A way that is comprehensible for everyone. So you can surprise your family during the Christmas dinner and explain what inflation is. And finally, convince your grandma to give you more money this year. Cause, inflation. What is inflation? In simple words, inflation is a rise in prices that causes a decrease in purchasing power. The rate at which the purchasing power drops is measured by a variation in percentage of a selected basket of goods and services, the so-called Consumer Pricing Index. The goods and services in these baskets get reviewed annually to be up to date with the consumer trends. An increase in inflation expresses the fact that the currency is able to buy less goods compared to the prior period. What causes inflation? There are two types of inflation. Cost push inflation, in which inflation is caused by an increase of the production cost, namely wages and raw materials. In this case, we have that the demand of products stays the same, but the supply decreases due to the higher cost of production. So this difference gets transferred to the consumer in the form of higher prices. And demand pull inflation. In this case, we have that there is a surge of demand for a limited supply. More demand for a limited supply will mean that the consumer will pay a higher price to get the goods, increasing the prices as a consequence. This happens when there is economic growth, so the confidence is high and an increase in spending follows. These two basic scenarios can be influenced by a variety of factors, such as monetary supply and policies. An increase in money availability can influence the consumer habits, driving more demand and causing demand pull inflation. On the other hand, a decrease in money availability can cause a slowdown in spending and in the entire economy. We'll dive deep in this topic later in the video. Wages increase that can be caused by some shortages of labor in some industries. So companies increase the wages, giving more purchasing power, and so they can cause some demand pull inflation. Exchange rates that are also influenced by the money supply. These can make or break the cost of import and export, influencing the cost of goods and so causing cost push inflation. Geopolitics that plays a very important role in the cost of raw materials. For example, think about the cost of wheat and oil since the war in Ukraine. Natural disaster, and again this is a non-economical factor that can influence the price of raw materials. Imagine a hurricane destroying an entire crop and increase the price of grains. How interest rates influence inflation? As we said in the previous chapter, inflation is influenced by the monetary policies and the monetary supplies. But what are monetary policies and monetary supplies? The money supplies refers to the amount of money that is held by a particular public in a point in time. Based on the money aggregates, we can have several monetary supplies, defined as M1, M2 and 3. For example, M1 in US refers to the most liquid assets in the economic system, such as cash, bank deposits and cash-like securities. This can be influenced through monetary policies, so through the interest rates on sovereign bonds. With an increase in interest rates, people will buy more sovereign bonds, and the amount of money in circulation will decrease. On the other hand, with a decrease of interest rates, people will sell more sovereign bonds, and the amount of money in circulation will increase. This happens because we are talking about sovereign bonds. So whenever we are selling or buying these, we are giving back or receiving money from the state itself. The sovereign bond market also influences the loan market, because the sovereign interest rate is the base over which interest rates for loans are computed. So with an increase in interest rates, people and businesses will stop borrowing money and will decrease the demand, slowing down the economy. On the opposite side, low interest rates stimulate the economy and the demand, increasing borrowing. We can imagine money and goods as a balance. Imagine that on the left plate we have all the goods produced in a period of time, and on the other we have all the money present in a period of time. Now, to make things easier to understand, let's say that at the initial stage we have 1000 euros corresponding to 1000 goods, and in this way the balance is in equilibrium. In this case, we'll have that any goods has a price of 1 euro. If we decrease interest rates, we have more money in the system. Let's assume that we double the amount of money in circulation. Now we have 2000 euros in this equilibrium with the 1000 goods that we had before. So now the price per single good is 2 euro each. The point is that at the more money in the system, more goods needs to be produced, or we'll have high inflation. Because inflation is a natural consequence of the economy, and supposedly should grow at 2% yearly with the growth of the economy itself. But too much inflation can cause the mess that we are living right now. What happened in the last 4 years? So in the last 4 years, the virus hit. The economy started to shut down completely and economic support measures were taken. Just to give you an example, people in US received a stimulus check of $3,200 and several other measures. Interest rates were lowered to stimulate economy and spending. Namely, we had our man, Jerome Powell, that pumped money in the system like there was no tomorrow. The so-called printing. And other countries did the same. Billions were pumped in the stock market that had a hockey stick moment in 2021, especially tech stocks. Why this happened, we'll explain in another video. In this way, there was too much money in the system, too much demanding, causing an economic overeating, to the point that prices had to increase to keep up. Imagine the balance we talked about before. But in this case, we had something like 4,000 euros on the right arm. To give you an idea, this is what happened to the M1 monetary supply in US. Other forces were also at play due to issues in supply chain, especially since a good part of the global production is nowadays made in China. And this nation was completely stunned by the pandemic. And later, we also had an increase in the price of oil and wheat due to war. This created the inflationary waves that we are still seeing today. To contrast this, central banks had to increase interest rates on sovereign bonds to cool down the economy. And this is the reason why borrowing money now is expensive as hell. So guys, thank you for watching the video. I hope you learned something, and if so, please leave a like and subscribe and go check my other videos here. Bye!